Welcome to the deep dive. Today, we're taking a closer look, really digging into a company that some of our sources are calling a wealth-creating machine. That's Brookfield Renewable, operating right in the heart of the global renewable energy sector. And our goal here, our mission for this deep dive, is to really unpack what makes them tick. What's the strategic secret sauce? We want to understand how they've managed such strong returns and, maybe more importantly, can they keep it up? We're looking at projections mentioned in our sources, suggesting a $1,000 investment now, this July, could potentially grow to over $4,250 by mid-2035. Quite a claim.
Yeah, it is quite a claim. And yeah, to really get a handle on that potential, we need to break down the key parts of their business model. And, the growth strategies they're using, the ones highlighted in the material we've looked at. It's about seeing how a company in renewables, a sector with huge demand, actually builds and, crucially, sustains value over the long term.
Okay, that makes sense. So to get that context, we probably need to look back a bit first, right? I mean, becoming this powerhouse, this wealth-creating machine that doesn't happen overnight. What does their history tell us?
Absolutely. The track record, it does paint a pretty compelling picture. If you look back, since 2001, they've consistently grown their dividend. We're talking a 6% compound annual growth rate. That's steady. And that consistency, well, it's fueled an average annual total return for investors of about 15.6% over the years. Now, obviously, you always have to say past performance doesn't guarantee future results. We know that. But still, having that kind of history really sets the stage for their current outlook. It gives them credibility.
15.6% average annual return. Wow. Okay, so that's the history, a really strong foundation. Let's pivot to now. Our sources talk about a strong base return that Brookfield offers today. What does that actually mean right now? What's the foundation look like?
Right. So the base return today starts with their dividend yields, currently sitting around 4.5%.
4.5%.
Yeah. And just for context, you compare that to the S&P 500, which is less than 1.5%, so it's more than 3 times higher. That alone gives investors a pretty solid starting return.
Okay, but is that sustainable? A high yield is nice, but can they keep paying it?
That's the key question. And the answer seems to lie in how they structure their business. It looks very sustainable. Get this, 90% of their electricity sales are locked in under long-term contracts.
Yeah.
These power purchase agreements, or PPAs, fixed rates, long terms, the average contract they have still has 14 years left on it.
14 years, okay. That's stability.
Exactly. And it gets better. About 70% of their revenue that comes through these PPAs, it's linked to inflation. So it's not just predictable cash flow, it actually grows predictably with inflation. They estimate this alone boosts their funds from operations FFO by about 2% to 3% per share each year.
FFO, right? That's the key metric for these kinds of companies, isn't it? Shows the actual cash they're generating.
Precisely. It's a much better indicator than standard earnings because it adds back things like depreciation, which is huge for asset-heavy businesses like this. It shows the real cash flow from operations.
Okay, so super stable base, inflation protection built in. But you mentioned the renewable energy market itself is really dynamic. Prices aren't static. How does that play with these long-term deals?
Yeah, good point. The market dynamics actually work in their favor right now. The market price for renewable energy is actually climbing faster than general inflation. There's just so much demand globally. So as those older PPAs expire, Brookfield can often recontract, locking in even higher prices for their power. This recontracting, plus other things they do to enhance margins, is expected to add another, say, 2% to 4% to their FFO per share growth annually.
Ah, I see. So they benefit from the stable contracts and from rising market prices when those contracts renew.
Yeah. Exactly. So you put it all together, you've got stable, growing cash flow from the existing assets, plus that ability to capture higher prices, all backed by a really strong investment-grade balance sheet. That's a very solid foundation.
Okay, that covers the base really well. Impressive history, solid present. But wealth-creating machine implies future growth, right? Big growth. So beyond managing the current assets, how are they actually driving that future growth? What are the additional engines our sources talk about?
Right. The growth story really kicks into high gear here. It's mainly driven by two things: a huge development pipeline and strategic acquisitions. First, the pipeline. They have, get this, 74 gigawatts of renewable energy projects currently in advanced stages of development.
74 gigawatts? How big is that compared to what they run now?
It's almost double their current operating capacity, which is around 45 gigawatts. It's massive. And they're not just sitting on it. They plan to commission about 8 gigawatts of new projects just this year. And they're aiming to ramp that up to a target of 10 gigawatts coming online annually by 2027. Just this development activity is estimated to add another 4% to 6% to their FFO per share growth each year. That's a huge amount of building. Yeah. Can you give an example? What kind of projects are we talking about, and who's buying all this power?
Yeah, a really interesting example is the deal they struck with Microsoft last year. A huge one, 10.5 gigawatts. These are projects specifically for Microsoft, expected to come online between 2026 and 2030.
Microsoft, so big tech companies directly contracting for massive amounts of renewable power.
Exactly. It highlights this immense and growing demand for electricity, especially to power things like AI data centers. That's a key driver. And Brookfield is positioning itself as a go-to partner for these huge, complex deals.
Okay, so development is one engine. What's the other one you mentioned? Acquisitions. Yes, acquisitions. But they're very specific about doing what they call accretive acquisitions, meaning the deals are expected to add to their earnings or value per share pretty much right away. And a key part of their strategy here is how they fund them. They use capital recycling.
Capital recycling, what's that?
It's quite smart, actually. They sell off mature, existing assets, often ones where they've already created a lot of value and maybe the growth is slowing, usually at strong valuations. Then they take that cash and reinvest it into new, higher growth opportunities like these acquisitions or funding their development pipeline.
So they're constantly optimizing their portfolio. Any recent examples of these acquisitions?
Sure. They recently bought Neoen, a French renewable energy developer. That really beefed up their pipeline in Europe and other key markets.
Yeah.
And very recently, they announced a deal to buy National Grid's onshore renewable platform here in the U.S. That deal alone adds almost 4 gigawatts of operating and construction assets, another gigawatt ready to build, plus a development pipeline of over 30 gigawatts.
30 gigawatts in just that one deal's pipeline.
Yeah, it's a significant expansion, strategically targeting high-demand areas. It shows their scale and ambition.
Okay, so we have this picture now. Strong history, really solid base return from existing assets with built-in growth, plus these twin engines of massive organic development and smart, accretive acquisitions. When you put all that together, these quartet of catalysts, as you call them, how does that translate into the total return potential, the part that leads to that wealth-creating machine label?
Right, so you add up the impact of all four. The base return and its organic growth, the boost from recontracting at higher prices, the growth from the development pipeline coming online, and the impact of these accretive acquisitions. The projection, based on their plans and market conditions, is that this combination should grow their FFO per share at more than a 10% annual rate.
More than 10% FFO growth per year.
Yeah, for the foreseeable future. And what's compelling is that a lot of this growth feels quite visible, quite secured. Based on the projects already underway and the contracts they have, it looks solid through the end of this decade and probably beyond. Then, on top of that FFO growth, remember the dividend. The company targets raising its dividend by 5% to 9% each year.
Okay, so strong FFO growth fuels strong dividend growth.
Exactly. So if you connect the dots, you take that current dividend yield of around 4.5%, and you add the potential for, say, 10% plus annual growth in FFO per share, which supports dividend growth. Well, that suggests Brookfield could potentially deliver total annual returns above 15%.
Which lines up with their historical average, interestingly enough.
It does. It builds on the 11% compound annual FFO growth they've actually achieved over the last 10 years. So it's an acceleration, but from a strong base. And that fundamentally is why those sources project that if things play out this way, a $1,000 investment made this July could theoretically grow to over $4,250 by mid-2025. That compounding effect of yield plus strong growth.
Right.
So boiling it down, the key takeaway seems to be this multi-layered strategy. It's not just one thing. It's the stable, inflation-linked cash from today's assets, funding tomorrow's massive growth through development and acquisitions, all happening in a sector, renewables, that's just booming. It creates this kind of self-reinforcing cycle.
That's a great way to put it, a self-reinforcing growth loop. So maybe a final thought for you, the listener, to chew on. When you think about this massive and clearly accelerating demand for energy, especially from new sources like AI data centers, how important do you think the structure Brookfield uses, these long-term fixed-rate contracts, will be? How might that influence not just their stability and growth, but maybe the stability and growth prospects for companies like them over the next few decades? And what does that model imply for how fast or how smoothly the whole global energy transition might happen? Something to consider.